opportunity here in some of these growthier names that have really been shellacked?
Well, it's very hard, Sarah, because right now it seems to be that everyone's buying all of the laggards, right? And from 2021, in addition to the interest rate sensitive names as well. The problem with these growth names is that when the momentum is on their side, they're great to own, and you don't have to pay attention to valuations, and we can talk about total addressable markets until the cows come home. But when things start to turn, there's no valuation support. So I would like to see, especially the Chinese internet names, I mean, they've been all over the place, but they're definitely beaten down. I get it. I guess they can get a bounce here. But I just feel like there are other places to put your money into 2022, especially because you just don't get a lot of visibility and transparency from any Chinese company. So I'd rather, if I'm going to play China, I might as well buy companies that are here in the States that have exposure to China, Caterpillar, Win, those kinds of Boeing, those kinds of companies. So, I mean, this has been a really interesting start to the year, guys. I mean, higher rates, huge rotation, the Fed, all in the first 4 days, and volatility a little higher. And on the flip side, we still see some pretty decent economic momentum in terms of housing and ISMs, and even auto production starting to hear that it's loosening on the supply side. And that's still 25%. Production's 25% below pre-pandemic levels. So can you just imagine when the spigots get turned back on, what kind of demand is going to be there? So, and of course, we always talk about the consumer being strong, and the ADP numbers really good, not only on goods jobs, but services and leisure jobs as well. And look, I mean, not all is perfect. We got Omicron. It's going to slow down in terms of GDP first quarter growth, but I think you're going to snap back. After that, you've got inflation. No surprise there. And that's why the Fed is going to be doing what they're doing. So I was surprised by the reaction yesterday, quite frankly. We've been waiting for the Fed to get more hawkish. They have been. They're going to go ahead and do it. They can, because they can normalize policy. So it's just a matter of being in the right sectors, and the sectors first, at least for the first 4 days of the year, have been much more cyclical, have been much more interest rate sensitive. You know that's where I have been in terms of the skew in my portfolio.
Well, maybe too hawkish and maybe too late is one of the reasons the market was worried.
Yeah.
Technology, as we've been mentioning, one of the worst performing sectors this week, down more than 3%. I did talk to Bridgewater Associates founder Ray Dalio earlier, asked him what he thinks investors should do with the group amid expected Fed tightening. Here's what he said.
Tech stocks have a very long duration, meaning they're sensitive to interest rate changes because the earnings and the payoff of tech stocks is very much in the future. So they're particularly sensitive to interest rate changes. And also, they've experienced, in many cases, a bubble type of behavior. And so they're more sensitive than, the meat and potato type of basic company type stock. So that type of behavior, this is not an environment that's particularly conducive to those types of investments.
Summarizing there, what we've seen in terms of the carnage lately doesn't sound like he's too excited about anything in tech. Steph, the Nasdaq's off 7% from the highs. Is there anywhere within here, the software names, the cloud names, chips, mega caps, anywhere that interests you in the tech group?
Yeah, I mean, look, I am 28% weighted in technology, excuse me, 22% weighted in technology. But my benchmark, if you add technology and comm services, it's 38%. So I am underweight tech. I have been. I think that there are some opportunities in security and cloud for sure that I will take a look at. But I just sold Fortinet, by the way, a couple of weeks ago, right before the holidays, because it was up 120%. It trades at 82 times earnings. And any bit of news that's not positive, that stock would fall 10%. By the way, year to date, that thing is down 15% in 4 days' time. So you have to take profits in some of these high-flying names. But I do like the total addressable market stories very, very much. And so if you do see continued pullback, yeah, I'd look at a Salesforce. I'd go right back into Fortinet. You know, I've pitched Palo Alto before. Those are all on my shopping list. For the time being, I own earners and I own valuation support stories. That's enterprise spend, that's HPE, that's IBM, that's Cisco, that is Meta, Facebook, 20 times earnings trading at a discount to its growth. And I own semiconductors, which I think are still very reasonably valued, NXPI, Lam Research, and Broadcom, which is buying back a ton of stock. So I think there's plenty of places in tech. You just got to be very selective and very careful on valuations and where earnings are coming from.